Ladies and gentlemen, it's a great pleasure having Maurice Mason here with me. Maurice, thanks for taking the time.
Thanks for having me, Ronnie. I'm a regular watcher of your podcast, so it's great to be on one of them. Thank you.
Thanks for the support of Caledonia. You're a premium partner of the Ingoldsby Trust Report for 2 years now. Thank you very much. Always a pleasure seeing you at conferences and events. We just talked before about the Beaver Creek conference and Denver Gold coming up. So I think compared to last year, where the sentiment was very, very bad in the gold world, this year, I don't know, it's probably agony would be the right term. Unless something wakes up in the next couple of weeks, but at the moment it's kind of the summer doldrums that we're experiencing in the gold world. But we'll see. I think that the macro setup isn't the worst. Maurice, I would like to briefly introduce you and your company. The topic of our conversation will be the topic of hyperinflation, how to work and deliver growth, deliver or manage a company, a mine in such a tough environment, and also what the opportunities are, and then of course what's going on at Caledonia at the moment, and where you would see the biggest upside of the company. So if you could briefly introduce yourself, Maurice, that would be great. You're based now in London, right?
That's right. Yeah, London. Yeah, thank you. So I've been with the company 7 years now. I was a former equity analyst, and Caledonia was one of my favorite companies when I was an equity analyst. And then when I left the equity analyst business, I joined Caledonia. They offered me a job, and it was an easy decision to make. I thought if I'm any good at spotting value as an equities analyst, I should take this job because I like the company. And if I wasn't good, I should take the job anyway because I had no business being an equities analyst. So it was an easy decision and a good decision. I do corporate development for Caledonia. So my job for the last 7 years has been looking for new assets, and obviously evaluating our existing asset and figuring out what we think it's worth. Because very often when you acquire new assets, you trade your equity. So you're giving away a portion of your business to buy somebody else's business. So you've got to have a very good idea of what you're worth, and then you've got to be able to figure out what other businesses are worth. So that's what we've been engaged in. We've got an exciting asset portfolio, which I'm sure we'll get into. So that's what I do for Caledonia.
And you've got, I think, a technical background. You studied engineering, right?
I'm an engineer by background, yeah.
And I think you prior to Caledonia, you worked for Stöferle, which is I really love their research. I think that Barry Bannister does a tremendous job on the strategist side. And and prior to that for Anglo, right?
That's correct. So I started my mining days in Anglo American, which was really big corporate organization, and then became an equities analyst looking at the junior side of the market. And then now I've joined the junior side of the market.
Excellent. And Caledonia, as I've said, is a premium partner of the Ingoldsby Trust Report for 2 years now. It's a gold mining company with operations in Zimbabwe. Your primary asset is the Blanket gold mine. But as we discussed previously, I think back in the days, you said it was a mispriced cash generating asset, and now it's really developing more into a development asset.
That's right. So we've acquired a portfolio of 3 additional assets in addition to Blanket. So Blanket is what we refer to as the goose that lays the golden eggs. It's a great asset. It's been operating 117 years. It's a mine we bought off Kinross in 2006. It was a bargain because of the hyperinflation, as you mentioned. We've looked after it well, and it's really paid us back many times over for that investment. So that's Blanket pays everybody's bills and pays the dividend to the shareholders, and keeps the business cash generative. And then, as I said earlier, we've been looking for several years now for new assets, and we've acquired the Bilboes project, which is a large project, 3 million ounces, grade of 2.3 grams a ton, large scale business, which has a feasibility study with it, which will support 170,000 ounce a year mine once it's in full production. And then we have two other properties which are earlier stage, but also quite exciting. One is Motapa, which is contiguous to Bilboes, so and essentially the same ore body, we think, but it's much earlier stage and needs development and exploration expenditure. But we think that could be potentially as big as Bilboes, and the whole thing will eventually be one large mining complex. And then Marley Green, which is another early stage development asset, a little bit further away, much earlier stage, and probably third in the priority list. But those are that's the portfolio we're looking at. And as you say, we've migrated from being, when we had Blanket on its own, we paid a healthy dividend, we were generating cash. We were essentially depending on investors' level of pricing of risk, we thought we were a mispriced cash generative asset. We've now migrated into a developer where we have an engine room in Blanket that generates cash and keeps everything going. But we're now focused on developing these new projects. They are large projects that will require capital, and so now we're migrating where the value for shareholders will come from the development of these large projects.
Thanks for the overview. We can talk about Caledonia a little bit more detailed later on, but the idea of this conversation was actually that I think when people hear Zimbabwe, everybody's the first thing that comes up is obviously the hyperinflation. And we had a look at hyperinflations in the 2022 report, and of course explained the root causes of inflation and hyperinflation, and the history, the present, but also the future of hyperinflations. In the last report and this year, we discussed the so-called cracker boom, a term that was coined by Ludwig von Mises, that also quite often goes hand in hand with hyperinflations. Now, when it comes to Zimbabwe, I think it's really staggering if you have a look at the numbers. At its peak in 2008, the hyperinflation in Zimbabwe was 89 sextillion%. So if you wonder, that's a number with 21 zeros. In 2006, the government removed 3 zeros. In 2008, they dropped another 10 zeros, and in 2009, they dropped another 12 zeros. Now, Maurice, what I wanted to ask you is, first of all, how is the situation in Zimbabwe now? And from your point of view, obviously, there's many risks and also challenges operating in such a hyperinflationary environment. But of course, as investors, we shouldn't care only about the risks, but also about the opportunities and the upside. So from your point of view, what are things that people completely underestimate and miss when they hear about investing and operating a business in Zimbabwe? And what has changed since the peak of hyperinflation over the last couple of years?
Sure. So I think there's a distinction between the current inflationary environment in Zimbabwe, which is high inflation, emerging market inflation, but probably not dissimilar to what you might find in Argentina or Turkey or other emerging markets that perhaps have macroeconomic challenges. So there's a very clear distinction, and I think you make this in your In Gold We Trust report. Hyperinflation is a complete collapse in trust of in the currency, and people just lose all confidence in the currency at all. So since the Zimbabwean dollar collapsed in 2009, they introduced originally a domestic currency, or de facto domestic currency, called RTGS, which stands for real-time gross settlement, and it was a currency that was used in the banking system, originally pegged 1-to-1 to the US dollar. Like most currency pegs, that peg was not sustained, and then inflation set in again. But we haven't seen in our operations in the country, and certainly it's not the case that there's hyperinflation again. It's a high inflation environment that presents us with challenges and opportunities in some ways, particularly regarding domestic currency, and we've had some situations, not by design but by accident, where domestic debts were eroded, because if you borrow money in currencies that are devaluing quickly, it gives us you have some gains on the income statement from that point of view. I think you make the point that it does present challenges, but it also presents opportunities. Let's not forget, we bought Blanket from Kinross in 2006 for $4 million. We're a $200 million business now, and we've paid millions of dollars in dividends to our shareholders over the years, and that turned out to be a fantastic investment, investing against the tide and expressing confidence in the geology and the people and the operating opportunities in the country, when everyone else, when all the other investors were basically diving for cover. So we're quite proud of our track record of investing against the tide. Like I said, to pick up a mine of this quality, it's now producing 80,000 ounces a year. All-in sustainings are below $1,000 an ounce. To pick up that business for $4 million and then have it now operating, it's worth many times that now. Also, I think Zimbabwe, there's no question that there probably is a less competitive environment for assets because of the macro environment. So some investors are a bit more nervous. Some of the international gold miners are a little more nervous, and therefore we believe that gives us a competitive advantage, because we think we can price the risk effectively and we can manage that risk effectively. People forget that Zimbabwe used to be the third biggest gold producer in Africa. And it used to be the fifth biggest gold producer in the world, if you go back. So this is elephant country from a gold mining point of view, and people have forgotten that, because really you had let's go back 1980s. Well, they declared independence from Britain in the 60s. They had a civil war for most of the 70s. Then there was a brief honeymoon period in the 80s, and then in the 1990s, things started. The previous policies of the Mugabe government started to have adverse economic consequences, and also there was a terrible gold market, so there was very little investment in the late 90s. And then in the 2000s there was the hyperinflation. So it's really a time capsule of development opportunity, where if these properties like Bilboes that we just bought were in Canada, they would have been developed 20 years ago. And so that presents huge opportunity for us, because we believe we can acquire these assets competitively, and we have the skills and experience to develop them.
That's clearly a sign that you and the management very much acts like, from a very contrarian point of view, which I truly like. And I wanted to ask you, Maurice, what are the other gold producers that are operating still in Zimbabwe? Are you one of the very few left, which obviously would give you quite a lot of leverage when it comes to acquiring new assets, and probably also regarding contacts that you've got within Zimbabwe. So who else is left in Zimbabwe?
So there are the other producers are domestic private companies that are some of them listed on the Zimbabwe Stock Exchange, but most of them private. So we're the largest producer, by probably some margin now, I think. And then there was the old Frida Rebecca property, which was used to be part of Moana Africa. That's still in operation. There's a company, Metalon, which is the former some assets. I'll have to get back to you on exactly where those assets were acquired from, but Metalon is still a reasonably sized producer. And then there's Rio Zim, which is actually listed publicly in Zimbabwe, who also have assets, but relatively small. I think last time we checked, we were about 15% of the country's gold production, and quite a large portion of the production comes from the artisanal or informal sector.
Yeah.
So there's quite a lot of small scale gold mining, gravity gold recovery, and so that's a fair chunk. About 50% of the actual gold production is from small scale producers.
So when it comes, I would like to learn a little bit more about how to actually operate in such a weak currency environment or hyperinflationary environment. What it means for your accounting, what it means when it comes to all the different parties that you're dealing with. So perhaps you could share some stories or views, what it does to your considering currency risk, how you negotiate contracts, what it really means from a financial point of view to deal in such a hyperinflationary environment.
Yeah, so I think the first comment we would make is again referring to the actual hyperinflation of 2009,
yeah,
where we owned the business. We bought it in 2006.
Yeah,
we owned it in 2009, and we had to shut the mine down, mainly because we weren't getting paid. So we only shut down for a period of about 6 months. But it was completely impractical to handle payments. There was originally we were getting paid in US dollars, and then there was a portion of the money that was being paid in domestic currency, and that was just completely impractical. So we had to shut down in 2009, and that was the only time the business had stopped producing. But I think I'd comment first of all, Ronnie, and say the human cost is something that people often don't realize. Our colleagues in Zimbabwe, many of whom we still work with, they're still with us now. We've got an incredibly low employee turnover. We saw firsthand our colleagues in the country who lost their savings, who lost faith in the monetary system, and who lost weight in some cases. You forget. I think a lot of the time, gold bulls, we almost want to be right. We want to be vindicated about the inflation, and as though there will be some day of reckoning coming for the profligacy of central banks. And I think we should be careful of wishing for that, just given the consequences we've seen of having good people lose their savings, lose their pension funds. The world of $5,000 gold is also the world of $300 oil and $20 copper, and sometimes I think we're a bit hasty to wish for that sometimes as gold bulls, and I'm not sure it's wise, just given our experience in country with a we employ 2,000 people at the mine. We have 5,000 people on the mine village, and all of them are Zimbabweans. There are no expats who come in, and their memories are very. It's a very scarring memory of that time. So I think then there's obviously the practical aspects of we report in dollars and we earn in dollars and we get paid in dollars. So that's generally not too challenging. We get a small portion of our revenue in domestic currency, and we have to manage and spend that currency without incurring devaluations if we keep it too long. But the flip side is, even domestic currency debt is quite expensive, but given the currency devaluations against the dollar, it does tend to also usually work out relatively cheap as well. So I don't know if that answers your question, but it's a.
I think one very interesting point that you touched were kind of the social consequences of inflation, and we've been in the recession camp for quite a while, and basically arguing that the world cannot afford such a massive rate of rate increases, and to be honest, 1 year ago I wouldn't have expected that that interest rates would be at 5.5% in the United States, and that
they'd be able to afford it.
The equity markets would still trade very close to all-time highs, but I wouldn't have expected that gold would also trade close to all-time highs, because now we really do have massive opportunity costs of owning gold. If you get almost 4% for 10-year US Treasuries, that's quite some headwinds for gold, and I think it's holding up tremendously well. And one point that I wanted to make is, people keep saying, well, you know, you're too negative about the economy, and just look at restaurants, just go to an airport. Everybody's spending money, having a good time, basically consuming probably more than they can afford. And I had some, I had the feeling that it sometimes feels like in Stefan Zweig's wonderful book, The World of Yesterday, where he describes the hyperinflation in Austria and later on in Germany, and it wasn't a dark time like many people would believe, but rather a time where people were partying. Yeah, they went to the opera, to the theater. They were spending money like there was no tomorrow, and actually the reason for that was that they completely lost faith in the future purchasing power of money. And if you're running like double digits in inflation like we do in many European countries nowadays, and if you're still getting basically 0% on your savings account, then I can understand that people will say, well, actually, screw it. Let's just spend the money, because it's gonna be worth significantly less in the future anyway. So I would say that this spending frenzy that we're seeing basically all over the globe is also, or could also be, a sign that people basically have changed into some sort of an inflation paradigm, where they believe that inflation now obviously is a topic, and that it will stay a topic for the future, which is obviously not a very positive sign. And that would also kind of explain why the price of gold is holding up so tremendously well. But I couldn't agree more with your words, Maurice. I think, be careful what you wish for. I'm not sure if a $5,000 gold world is really a good world where everybody wants to live in.
I think it might come, but we shouldn't wish for it. That's maybe that's our reflection on just looking at inflation, in our experiences of inflation. But Ronnie, to your point earlier about the current, I've been surprised that high interest rates haven't seemed to matter, and I think at some point they have to, right? At some point, the actual cost of this debt and the $1 trillion a year of interest expense that the US will carry, or the cost of even interest rates going to 1% in Japan, or all over the world, we seem to be of the view that we can raise interest rates and control inflation, and then take interest rates back down to zero again, and we'll be fine. And I was talking to somebody the other day, and they said, I think I'm just going to wait for interest rates to return to normal. And I said to them, they have returned to normal. This is normal. And if you go to 500 years of history of the Bank of England, this is a normal interest rate now. We just have a short time frame, and we don't read history books, and we don't do maths on these things. And so I think at some point the cost of debt is going to matter, and the interest expense for homeowners and governments is going to be a problem, which I think will reflect in bond yields, and that's I think going to be very bullish for gold, but very difficult for fiscal discipline within countries.
Absolutely. I mean, I think the the recession case is quite a strong one, and actually the market sentiment has really shifted from into, you know, soft landing, Goldilocks, mild recession, whatever. And as you know, one of the key takeaways of this year's report was our analysis how gold, but also mining stocks, silver, and equities in general perform in a recessionary environment. And the short reply is that, or the short summary is that gold does tremendously well over the course of a recession. Now, if you have a look at the yield curve, probably the most reliable recession indicator that exists, it's screaming recession. If you have a look at the leading economic indicator, I think it's down like 14 months in a row now. It's screaming recession. If you have a look at, you know, just history books, yeah, if you have a look at the labor market that is especially below the surface showing more and more signs of weakness, I think then it becomes crystal clear that that a recession is probably gonna happen. I don't know, fourth quarter of this year, first quarter of next year. And from my point of view, you know, the market is very, very much positioned for such a shallow recession or a soft landing. We had that in the report. Out of the 100 economists that are questioned by Bloomberg, just 4 of them forecast a recession for this year, and I think 5 for next year. And so those 4 or 5% just see a very shallow recession. Nobody's forecasting a really nasty recession. Very, very similar to 2008 and all previous recessions in history. So, but the kind of the sweet spot is the longer it doesn't happen, the longer central banks, and especially the Federal Reserve, will continue on their hawkish path. And then I think, you know, it's really only a question of time. And now the question is, why does gold perform so well over the course of a recession? Because obviously we will see massive fiscal stimulus and massive monetary stimulus. And you know, I think that the major change in the big picture is that now we're running basically full employment in the United States, and the government deficit the budget deficit is, you know, is enormous. So this, what we call the monetary climate change in the report in 2020, where we said, well, let's focus less on what central bankers are doing and focus more on what politicians are doing, focus more on fiscal stimulus. I think this is really materializing at the moment. And I think this is another reason why we haven't seen the recession yet, because governments all over the globe basically experienced or found out in 2020 that it helps them at the upcoming elections if they you know, if they send out government subsidies and checks and whatever. So I think this,
people like free stuff.
Yeah, exactly. But as we know, there's no free lunch. So yeah, I mean, it's a story that's or a topic that we could discuss for hours and hours, Maurice. And I think you being in London at the moment, you probably also see quite similar things like we are seeing in Europe and in the United States. I did a family trip to the US in July, and it's really staggering to talk with business owners there. And you know, inflation is the big topic. It seems everybody's kind of getting used to this inflationary environment, and many people that I talk to, they say, well, actually, you know, my pay raise was like 15% last year, so I'm doing well. And most people can only calculate, you know, on a nominal basis, but not on a real basis. And this is kind of the illusion, I think, that that many people fall prey to, that they're only thinking in nominal terms and not not in real terms. But let's come a little back to Caledonia, Maurice, and to Zimbabwe. You mentioned the social aspect, which is very, very important. And in this year's In Gold We Trust report, we wrote especially about the S in ESG, so the social impact. Could you tell us a little bit more about the social impact that Caledonia has? You know, you mentioned already how many people you're employing, and I think it's really crucial for us in the mining space to really make the positive case for mining and emphasize sorry, what mining does to local communities.
Yeah, I mean, absolutely. I think we're very proud of our social contribution. I already mentioned we employ 2,000 people. There are 5,000 people who live on our mine village. You know, so our workers live with their families, with their children. We have schools and clinics. This is a poor country and it's a poor community. So you know, these are people with honorable, good-paying jobs who would probably not have those jobs were the mine not there. And our view that is, and obviously the scorecards and the benchmarks are all important, but that one of the greatest real measures of social contribution is, are you obviously not polluting the environment, and are you creating sustainable long-term prosperity in that area? You know, the mine's been around 117 years, so clearly there's a long-term prosperity and an uplift of the people as a result of this. You know, our employee turnover is incredibly low. It's about 0.3%. So once people have jobs with us, they stay with us, which clearly, you know, we like that measure because it means that obviously they're happy with that partnership. As I said, it is a poor country. The demand will always exceed the supply, unfortunately. So you know, we will always be, yeah, the demand will always exceed the supply, so that we can't really stop that. But also, you know, we have a fairly unique structure, Ronnie, is that you know, we own 64% of Blanket. The Zimbabwean government owns 16% of it, and then our workers, there's a workers' trust who own 10%, and the local community own 10%. So it is very good social policy, we think, to have people feeling like you are a partner. You know, you're a neighbor, and you cannot have a sort of simple island of prosperity in a poverty-stricken area. The dividends that flow from the mine flow to the community. We paid, I think it's in our presentation, we pay millions of dollars a year in dividends to the local community. So it's yeah, we're very proud of the fact that we do make a very positive social contribution, and we do that while taking care of the environment. You know, we're currently investing quite heavily in a new tailings dam, which will store tailings safely for many years. And I think
also a power project, like a solar power project, right?
We do, yes. So that is we have a solar farm which does about 12 megawatts, which gives us electricity during the daytime. Obviously, it's not battery powered backup, so it doesn't work at night. But that's been a great investment, actually. Just that pays for itself. We're blessed with good sunshine as well as good geology in Zimbabwe, so that's worked just on a simple economics basis. But it also helps our ESG credentials. But it is something you know, just on a personal level, I feel quite strongly about, because we have this attitude in Europe that, you know, we don't want the mining to take place. You know, we all want cell phones and that made out of copper and aluminium, but we want that to happen far away somewhere, and we don't want the impact of mining in our own countries, which I think, you know, so it's important for us to stand up proudly and say, yeah, mining can make a very positive social contribution and bring good paying jobs and skills and experience, plus schools and clinics and taxes and all of the things that go with it.
I think most of the people that criticize mining in general, they've never visited a mine, and they've got no clue what's actually what the positive social impact is in the mining industry, and I think, you know, that's that's something that we've been pounding the table, is actually, if we want to achieve all those goals, yeah, net zero or whatever, I think we need significantly more mining and not less mining. I think this is really, really crucial to understand. And probably governments are kind of waking up now, and I also have very positive meetings with large institutional investors that now kind of realize, well, actually the mining industry is doing a good job. They've learned their lessons. You know, all the large producers, they've got very, very good ESG policies in place now, very good reporting. I think that was really a major achievement over the last couple of years. But then also, you know, they realized that all those new technologies, especially when it comes to the energy space, you know, will need significant investments and also infrastructure investments in the mining space. So I think this is kind of a topic that is kind of going mainstream now, very late, but it is happening. I just saw the report by the US energy ministry regarding critical metals. It's very, very interesting. Now nickel is being regarded as a critical metal from a US perspective. It's a very, very good read, and actually I think it's clearly showing that you know, after quite a long time of where commodities were not really being regarded as something strategically important, I think this is now really changing. But Maurice, I would to if we come to an end, I would like to ask you regarding the country of Zimbabwe itself, and especially when it comes to positive developments, what you're seeing. Is it becoming perhaps a little bit more of a tourism destination? Do you see more you know, foreign direct investments? Do you see good developments coming from, or supportive developments coming from the government? So what's going on at the moment?
Yes, I think we have. So first of all, it's been a very profitable investment for us. Let's just talk straight, simple numbers. When we bought the mine in 2006, our shareholders, we've done very well out of it, and we're very proud of that track record. So that, I think, first of all, speaks for itself. Secondly, we certainly have seen under the current administration, which came in about 2017, we've seen some very material steps to promote investment in the country, and that's borne out by our effort, our acquisition. You know, the Bilboes transaction was $60 million. That's a big investment in the country. So, for example, there was previously legislation which required mandated local ownership of mining assets. That's gone. So we still have local ownership because they're shareholders and they're partners, and we move forward on that basis for the blanket mine. But it's not required for any new investor to come into the country. And we are seeing, you know, there's the Cara project with Teresa Resources, which is a large PGM project, a good project from what we've seen, and you know, so we talk to the Teresa guys quite a bit, and you know, it sounds like they're serious about going forward and investing there. Also, another comment I'd make is we're seeing quite good developments in Zimbabwean capital markets, and this goes back to the hyperinflation and the memories of the people. You know, we're listed on the Zimbabwean on the Vic Falls Stock Exchange, which is a dollar-denominated stock exchange. So your shares are quoted in US dollars. So we have a listing in New York, a listing in London, and a listing on the Vic Falls. And we found quite good support from domestic Zimbabwean investors who want gold-generating assets, which give them inflation protection over time. And I think we'd have to check with Cara and with Teresa, but they also issued a bond listed on the Vic Falls Exchange. I won't quote the number because I'm not certain of it, but fairly substantial bond issuance there, borrowing in the dollar debt markets in Zimbabwe. So we are seeing capital markets maturing and promoting investment. investors and people have long memories, so I think it will take time. But I think we're playing the long game, as we've already demonstrated, and we're patient about it, and we think we're operating in one of the last gold frontiers in Africa from an exploration point of view.
Well, just as a little a side note, Maurice, we're considering a new fund at the moment, and we we crunched the numbers and also had a look at the history books, and at some point, end of the 1970s, beginning of the 1980s, the US had to issue bonds denominated in Deutschmark and in Swiss franc because nobody trusted the US dollar anymore.
There was to be Carter, wasn't there? They were called Carter bonds, I think.
Exactly.
Yeah, that's right.
And then we also had, I read an interview, a very old interview with a bond manager back in the days. And at the end of the 1970s, it was just normal for a US government fund to hold up to 30% in physical gold. So pretty interesting. Times are changing, and
Sorry, apologies. How if you're right about inflation, how long are the 10 and 30-year yields going to stay? Stay in the sort of region that they're in, right? I think that's going to be if you're right about inflation, and I've been humbled because I was expecting inflation 5 years ago, and I haven't seen it. Yeah, well, sorry, we've seen it, but it's everyone thinks it's going to return back to normal and get back to the 2% range quite quickly. If that's not the case, how long before the 30-year bond starts pricing that effectively, and what does that do to pension funds? It's interesting times.
Well, I think if we in the Western world want to know the future of central banking, then we just have to look at Japan. They're always a couple of steps ahead, and they did, like, I think 12 or 13 rounds of quantitative easing. They introduced yield curve control, and I think this is also something that we will be seeing at some point. That they will come up with kind of a ceiling for government debt. I think that's something that's probably gonna be as it usually works. It's being kind of tested how the market reaction is, and then there is some very sophisticated papers coming out from the Federal Reserve and some scholars, and then it's being implemented. And I think over the next probably 12 to 18 months, something like that will be implemented. So if I would say, now with the 10 years, I don't think that for the time being they will go above the October highs that we saw last October. But there is clearly pressure. But on the other hand, if I look at many institutional players, and if I visit like industry events, that the big common topic is obviously bonds are back, and everybody's saying, well, now is the best time to buy government debt again, offering really attractive yields. And I would agree that the market sentiment is that inflation rates will come down very, very quickly, and will go back to the old inflation narrative, this this great moderation world that we've been in for roughly 40 years. We as you know, we always said we'll see at least one more inflation wave, and I think this next inflation wave is probably already being prepared. And so obviously there will be quite a lot of things to write about, to think about, to talk about, and so we look forward to quite a lot of special publications coming up in fall and winter this year. Maurice, I think we'll
reading them, so
we'll come to an end. I thank you very, very, very much for giving us a perspective on what it means to operate in such a high inflation environment. I think you guys did a tremendous job, a very bold move to come at a very challenging time to Zimbabwe. As you said, used to be one of the top gold producers in the world. It seems, as far as I did my research and as far as we discussed, that quite a lot of positive things are developing in Zimbabwe. I thank you and the whole team at Caledonia for being a premium partner of the In Gold We Trust report. Otherwise, it wouldn't be possible to put out such a massive report completely free of charge. And yeah, I mean, any final words that you want to say, Maurice, about the company, about something that's that people might be missing when it comes to Caledonia?
The thing I give to investors most of the time is we say it's all about pricing of risk.
Yeah,
and that, to me, that's a really key investment philosophy. Is, you know, we think we can understand and manage the risk better than most, and the question for investors is what's a fair price for that risk. And we can't really answer that for our investors. We can just understand and manage the risk as best we can, and look at the upside and the opportunity, and that's what we do. So we're proud of our track record. I think it speaks for itself. We're taking a long-term view, and we have very attractive projects, which, if investors are interested, they can contact myself or my colleagues, or just look at our website. You know, we think we're sitting on very exciting development assets. Obviously, they will take some capital and some work to develop, and that is the migration the company's gone through over the last few years. But we're excited about the future, and we're very happy to be associated with In Gold We Trust. So thank you for your time.
Thank you very much, Maurice. All the best. Yeah, we'll see each other in Beaver Creek. I really look forward to catching up with you. Yeah, thank you for watching. Have a look at the webpage of Caledonia Mining. It's really worth. Have a look at their ESG reporting, for example. It's really well done. And yeah, thank you for watching this video, and have a look at the In Gold We Trust report webpage as well. Thank you very much, and take care. See you soon. Bye-bye.
Cheers, Ronnie. Bye-bye.